Imagine a world where credit card companies aren't just taking your money, but you're actually playing them at their own game. Most people view credit cards as simple financial tools, but they're actually sophisticated psychological and mathematical systems designed to extract maximum profit from unsuspecting consumers. Today, we're pulling back the curtain on 5 mind-blowing credit card tricks that banks desperately hope you'll never understand. Every credit card reward program is meticulously engineered using complex algorithms that predict consumer behavior with frightening precision. These aren't random benefits, they're carefully calculated incentives designed to modify your spending patterns while creating an illusion of financial gain. The mathematical models underlying these programs are so intricate that they can anticipate your financial movements with near-prophetic accuracy, transforming seemingly benign rewards into strategic behavioral nudges. The fundamental architecture of credit card rewards revolves around sophisticated behavioral economics principles. Banks aren't offering points or cashback out of altruism, but as carefully constructed psychological triggers designed to influence long-term consumer behavior. Each reward tier, each point multiplier, and each bonus category is mathematically calibrated to create a sense of perceived value that subtly encourages continued card usage and increased transaction volumes. Sign-up bonuses represent a particularly ingenious mechanism of consumer manipulation. These initial rewards aren't gifts, but calculated investments in future revenue streams. By offering an attractive introductory package, banks activate a psychological principle called reciprocity, statistically increasing the probability that consumers will maintain long-term engagement. The initial bonus serves as a strategic hook, designed to create emotional investment and habitual card usage. Interchange fees represent the invisible financial infrastructure that powers reward programs. Every transaction generates a percentage-based fee paid by merchants, typically ranging between 1.5% and 3.5%. Reward cards with premium benefits often carry higher interchange rates, meaning consumers are indirectly funding their own rewards through increased transaction costs. Understanding this mechanism allows savvy users to strategically select cards that align with their natural spending patterns. Credit utilization emerges as a critical, yet frequently misunderstood aspect of credit management. Contrary to popular misconception, carrying a balance doesn't improve your credit score, it potentially damages your financial profile. Maintaining a low credit utilization ratio, ideally below 30%, signals financial responsibility and can dramatically enhance your credit rating. The scoring algorithms reward disciplined financial behavior, not debt accumulation. The psychological design of credit cards extends far beyond mere financial mechanics. Color schemes, reward presentation, statement layouts, and even digital interfaces are meticulously crafted to subtly influence consumer perception and spending behavior. These design elements represent a sophisticated form of behavioral engineering, creating emotional responses that guide financial decision-making without consumers consciously recognizing the manipulation. Strategic category rotation represents another advanced technique for maximizing rewards. Credit card companies frequently shift bonus categories to maintain consumer engagement and prevent predictable spending patterns. By tracking and anticipating these rotations, sophisticated users can optimize their cashback and point accumulation without increasing overall spending, effectively turning the reward system into a strategic game. The most powerful approach to credit card management involves developing a holistic understanding of these complex systems. Rather than viewing credit cards as simple financial tools, consumers must recognize them as intricate instruments of behavioral economics. By demystifying the hidden mechanisms, individuals can transform from passive participants to strategic financial players. Ultimately, credit cards are neither inherently good nor bad. They are complex financial technologies designed with remarkable psychological precision. The real power lies in understanding the intricate systems that shape economic choices. Knowledge becomes the most valuable currency, enabling consumers to navigate these sophisticated reward landscapes with intelligence, strategy, and financial wisdom. Did you know that the average American leaves behind approximately $1,500 in unclaimed credit card rewards every single year? Most people have no idea how intricate and strategic credit card reward systems truly are. Welcome to a revealing exploration of the hidden financial mechanisms that banks desperately want to keep secret. Credit card companies are mathematical masterminds, designing complex reward ecosystems that look simple on the surface but operate with stunning precision underneath. Think of these systems like sophisticated video game economies, where every transaction is carefully calculated to maximize their profit while giving consumers just enough incentive to keep playing. Let's break down the first critical secret: point multiplier optimization. Credit card companies intentionally create tiered reward structures that psychologically nudge you towards specific spending behaviors. For instance, some cards offer 3x points on dining, 2x on travel, and 1x on everything else. This isn't random, it's a carefully engineered strategy to influence your spending patterns. Imagine your credit card as a game board where each spending category represents a different zone with varying point values. Banks strategically design these zones to encourage behaviors that benefit them. When they offer 3x points on dining, they're not just being generous, they're studying consumer trends, knowing that millennials and younger generations tend to spend significantly more on restaurant and delivery experiences. The second hidden hack involves understanding what banks call interchange fees, the invisible transaction costs that most consumers never think about. Every time you swipe your card, merchants pay a percentage to the card issuer. These fees, typically ranging between 1.5% to 3.5%, are the primary revenue source for credit card companies. Reward programs are essentially marketing expenses designed to attract customers who will generate more interchange revenue. By comprehending this mechanism, savvy consumers can strategically choose cards that align with their natural spending patterns. If you're someone who travels frequently, a card with higher travel rewards might generate more value. If you're a foodie, a dining-focused card could provide substantial benefits. The key is matching the card's reward structure to your lifestyle, not just chasing flashy sign-up bonuses. The third secret revolves around credit utilization and its complex relationship with reward optimization. Most people view credit limits as spending boundaries, but sophisticated users see them as strategic tools. Your credit utilization ratio, the percentage of available credit you're using, dramatically impacts both your credit score and potential rewards. Here's a counterintuitive insight. Maintaining a low but consistent credit utilization between 10% and 30% signals responsible financial behavior to credit scoring algorithms. This sweet spot demonstrates you're actively using credit without appearing desperate or overextended. Credit card companies reward this behavior with better terms, higher limits, and more attractive reward rates. Our fourth revelation concerns the psychological design of reward redemption systems. Credit card companies intentionally create slightly complex redemption processes to reduce the likelihood of users actually claiming their points. They understand that a percentage of earned rewards will simply expire or go unused, representing pure profit for the issuer. To combat this, develop a systematic approach to tracking and redeeming rewards. Set calendar reminders, understand your card's specific redemption rules, and treat reward points like a valuable currency. Some cards offer better redemption value when points are converted to travel miles or transferred to specific partner programs. The final and perhaps most powerful secret is understanding the concept of reward stacking. This advanced technique involves strategically combining multiple credit cards to maximize point acquisition across different spending categories. By having 2-3 complementary cards with unique reward structures, you can essentially create a personalized rewards ecosystem. For example, one card might offer exceptional dining rewards, another might excel in travel points, and a third could provide excellent cashback on everyday purchases. The key is viewing your credit card portfolio as an integrated system rather than isolated financial tools. A critical disclaimer: these strategies require disciplined financial management. Reward optimization only works if you pay your full balance monthly and avoid interest charges. Credit cards are powerful financial instruments that can,